All right, well, why don't we go ahead and get started? If I could do just one more sound check with you, if you don't mind. So I think my audio is working well, and you should be looking at a slide that says Introduction to Vanilla FX Options. Is that coming through okay? Great. Great. Awesome. Well, I'm excited to be here, everybody. This is actually something I've been looking forward to for a few weeks because uh, when you do a normal webinar, it's a lot of fun, but sometimes you think, "Wow, how can I squeeze in all this good stuff into 45 minutes?" So we've got a lot of extra time today, and part of the what I would like to solicit from you is we do have some time, and I'd like to make sure that we don't get halfway through and then somebody gets a little bit lost, or a third of the way through and somebody gets a little bit lost. If you have a question or if I'm being unclear, I'd love for you to be able to ask. Feel free to ask questions. I can see my control panel here, and if you have a question, I can probably get to it. So let me do a little introduction first. Number one, who am I? For those of you who haven't heard me speak before, my name's John Jagerson. I'm one of the founders of PFX Global, and we wrote a book a few years ago that has become quite popular as a website. And I've been in the Forex business for quite a while. And I've been on both sides of the business for several years, both as a retail trader consistently myself, as well as on the services side. So I've owned and operated a CTA for a long time, and are a commodity trading advisor. So we do trading for Forex customers, as well as working as an IB for IBs and with dealers themselves. So I've seen, I guess the reason why I bring that up is that I've seen both sides of the market. So I know what goes on the services side of the market, if you will, and I know what goes on the retail side of the market. And Forex options are something that I've been looking forward to for a long time, but are actually, it's fairly new that they've become widely available. So this is one of the reasons why a lot of old options traders like myself from the stock market, so using stock options and using options in the futures market, are so excited about FX options right now. And they have a number of really great advantages, and they borrow a lot of the advantages that that the Forex itself has. Probably number one of which is liquidity. So Forex options benefit quite a bit from the fact that the Forex itself is extremely liquid. So I want to define one of the terms here. It says vanilla FX options. The Forex is really interesting because it's so, I mean, it's relatively new as an opportunity for retail traders, so individual traders. And because it's new, everything is kind of old products as well as new financial products have kind of grown up together. So, which is interesting because there in the Forex, I see traders really using two types of options. The first is vanilla, which is what I'm going to be talking about. So, for those of you who have ever traded options or ever listened to one of these webinars that I've done on FX options, vanilla options are calls and puts, essentially. And but there are a whole class of options called exotic options that. So my partner Wade Hansen is doing a premium webinar here right after I'm done on exotic options. There is a difference, and exotics are, in fact, they're most commonly called fixed rate options or binary options. So, for example, if you've heard of or been reading about barrier options, knockouts, knock-ins, one touches, no touches, those sorts of things, where you basically, they're also, one of their names is a fixed rate option because oftentimes with an exotic option you will pay a certain amount. So let's say you'll pay $100 for an option, and it has a fixed payout if something happens. So you'll pay $100 and you'll get paid $1,000 if the euro hits a buck 46 in the next 30 days or something like that. And so they have exotic options have some advantages in that they're very simple, but where vanilla options really shine is that they're extremely flexible. So a vanilla option, we have the ability to choose a little bit more efficiently from all the choices available, and we can reevaluate because the market is very liquid. We can reevaluate those opportunities on a day-to-day basis, hour-to-hour basis. I even know a couple of options day traders, if you can imagine that. So we'll why don't we go ahead and get started? And I'm actually going to start. I'm going to bring up my charts. I want to make sure everybody can see this. Oops. Let me stop sharing, and I'm going to bring up my charts. Okay. So I have a charting station here, and I'm just going to bring up the Euro US dollar. So if you can't see this, let me know. But the Euro US dollar, so quite a breakout here that we've been experiencing. This is actually pretty exciting. And if we were an options trader and we only had options available to us, there's a couple of recommendations that I'm going to make. I actually have quite a few strategies that I would like to show you, and I plan to go into some pretty good detail. But as I go through my presentation, there are a couple of places that I would like you to, or that I would suggest that perhaps you have a notepad in front of you and you make a couple of drawings that look like what I'm drawing on the screen. So I'm going to do a little introduction. I'll warn you when I have something like this, because it's, all of us had to start somewhere, and one of the little tools that I'm going to show you today that you can use to understand the option that you're analyzing, it really helps if you've had some experience just sitting down and drawing it out yourself and kind of thinking through it, because because options give you options, so they give you flexibility, there is some complexity, and it will help to make a little bit more sense. So I'll give you some advance warning, but I got one of these coming up here in just a second. So we're looking at the Euro US dollar, and as an option/Forex trader, I really have two alternatives in front of me. I could go long the Euro US dollar, which would have been a great decision last night, and depending on whether you're a long-term trader or a short-term trader, you might already be long. And at this point, right now, the current price is $42.90 or so. So I've got $42.90. And in fact, I'm going to just draw a little line here across the top of the market. So I'm just breaking above this resistance level. $42.90, and I have a couple of choices. Number one, I could go long this position, and let's just long the Forex pair. And so let's say that I did that. I'm going to go long this the Euro US dollar. But I clearly I'm going to want to establish some risk control. So I'm going to want to put a stop loss in. And in order to do that, so remember, this is an introduction to Forex options. So there's some stuff that I've covered before in past webinars, but I want to make sure that I'm really fair to all of the attendees. So we're going to cover right from the very beginning, and I think this will be a good review. But this is probably one of my favorite explanations for why an option makes sense. So let's say that I'm going to be doing this from my perspective. So I'm a more, I guess you could say long-term for the Forex trader. I'll be in a position for weeks, maybe a couple of months in some cases. But even when I'm just trading the Forex rather than trading a particular strategy, I might be in and plan to be in a position for a while. So if I'm opening up, but the principles are the same. So although my stops and limits may be pretty wide, if you're a short-term trader, it's the same concept. So I'm looking to go long, and we're imagining that we're going to be going long at about 42.90, and the market's already moving on us. This is amazing. This is going to be an amazing day, I think. I did not expect this volatility this week, or this much volatility this week. This is really cool. So, and I want to place a stop on this because I think this is the breakout that we've been looking for, and I'm thinking that we're probably going to hit 46, 47, something like that. Now in the meantime, I want to be able to place a stop, and I'm going to put a stop right at support. So I drew it right through this doji here, a period of indecision. That's pretty reasonable. It's right underneath this consolidation that occurred in the middle of October here recently, the consolidation we just barely broke out of. And so we're bouncing off very nicely off of that. So I'm going to put a stop down there. That's at about 41.40. Okay, so I've given myself a pretty wide spread. So I've got 150 pips. Now I don't have to do that. I could even say, well, what if we scooted this up a little bit? What if we put it right in the middle of this consolidation here? In fact, more towards the top of it at 42. So that's not unreasonable as an alternative for us to evaluate. Now here's the issue, and as exciting as this volatility is today, so we've got this nice breakout today. The question is, all right, but is the market going to retrace? And if it does, how far is it going to go down? And anytime you're placing your stop, you always you kind of have this thread that's connecting you to your computer monitor, and you're thinking, do I want to go too far, because the market's beginning to drop. It's getting down here to 42.50. It's getting down here 42.30. Boy, maybe I need to move that stop, because the thing that we're all fearing is, of course, being whipped out on our stop loss, where the market comes all the way down to 42, hits that level, and then pops right back up again. So we were right on the trade, we were wrong on our stop, and we just washed out. So even if we'd put it at 42, we just washed out 90 pips worth of profit. Happens to all of us. We all deal with it. It's a reality of trading in the Forex. No problem. Well, here's the alternative. So the most basic options trade that we could place in any situation is a long options position. So what that means is we're going to go buy an option. We're not going to short it or anything like that, which we are going to talk about today. But we're going to go buy a long options position. And in this case, so this may be a place to write down a note, because there is some verbiage, some words. There's a vocabulary associated with options trading that you have to be familiar with. And if you're not already familiar with it, this will be helpful. So we're going to buy a call. Now, people will oftentimes make the mistake of making a mental note to themselves. Calls equal bullish. Not so, not so. Calls, a long call, buying a call is a bullish trade, because we're going to talk about selling calls as well, which is bearish. So buying a call is bullish. Now I'm going to switch gears here a little bit. I'm going to go off of my charts, and I'm going to bring up a little diagram here. And this is where this is something that would be worthwhile for you to copy onto your own notebook. And it's something that options traders, we live or die by these. If you look at an options trader's notebook, you'll see these written all over it as they're trying to plan their position. And of course, as you learn the basics, there are most of your options, good options brokers will actually provide software that will do this for you automatically. But learning how to read it and how to draw it is really important. So here's what this is. All right, down here on the bottom we have so this is just a graph. Down here on the bottom we have prices. So this is the price. This is where we think about the price of the euro US dollar. And of course over to the right, that's as prices are rising, that's going to the right. As prices are falling on the euro US dollar, prices we're going to the left. So so this is the price of the underlying. This is our profit and loss. So basically here's what happens. We're gonna mark a little spot right here. This is in prices. This is $1.42.90. Boy, my handwriting is terrible on the computer. Okay, so that's $1.42.90. If the price increases, so if we're going this way, we're going to make money. If the price begins to fall, we're going to lose money, because ultimately we had a bullish outlook and we were trying to go long. Well, here's how an option works. So we're going to be, and you'll notice that I've got a whole nother axis on here. Losses below this line right here, and profits above that same line. So again, this is called an options risk graph. When we first enter a long options trade, you're already starting in a losing position. Now, don't get panicky about that, because all that means is that that you had to pay something to get into that option. But over time, if prices go the direction that we think they are, so I'm drawing this line out to the right, then all of a sudden our option becomes worth more money the further we go out to the right. And ultimately can become worth, it has no cap on it. It's just like being long the Forex position itself. If the underlying price, so if the euro US dollar goes up to 48, we're still making money up here on this option. But if the underlying, if the euro US dollar really doesn't go anywhere, we just kind of stay in this small losing position. So if we go 30, 40, 50, and I'm going to show you exactly how many pips that the market would have to move for you to be able to make money, if you assume that you hold that option from the time that you bought it all the way through till the time it expires, because options do have an expiration date on them, and I'm going to show you that here in just a minute. But and then of course, here's the real advantage. The question is, well, does an option then go like this to the downside, unlimited, if the market begins to drop? No, it doesn't. And that's the real advantage of trading an option, is that loss is fixed. It can't go any further. You could apply stops to options, but most options traders don't. There's reasons for that, but usually it's just not necessary. You just don't plan your position that way. No matter how far this particular index moves, so the euro US dollar, you don't, to the downside, you don't lose any more than what you had originally invested. So this little delta between break even and your loss, that's your max loss. Now I'm going to shift gears again, so I'm going to go to another application. So I hope that you're taking me up on my advice to write these down, because we're going to be doing several of these risk graphs together. So I'm going to go to my web browser. And I'm going to give you all the URLs that, in fact, I'm just going to type this one in so that this is the CBOE. And the CBOE is the Chicago Board Options Exchange. Big options exchange in the US. The CBOE has a lot of great information on it and a lot of really cool tools. And I'm going to show you a couple of things right now and how to get there. It's really easy. Because one of the things that you're going to find as you become a Forex options trader is that your dealer will not have information about Forex options. It's just not what most dealers do. There are actually a couple of dealers who do have Forex options, but here's a couple of disadvantages that I've seen. In fact, I only know of one dealer who has a good options desk. That's one out of the major dealers out there. Other than that, most of the dealers who are offering vanilla options, the service is really bad, the liquidity is poor. I don't like it, and I figure, it doesn't matter whether you like it or not working with the dealer, because these options are exchange traded, which has advantages in that they're transparent, they're liquid, and they're highly available. You just need to be able to work with an options broker to get them. So I'm going to give you a couple of tips today, by the way. So there's two things that I'm going to show you. Number one, I'm going to show you how to pull an options quote from CBOE, because you can get them for free. And I'm also going to show you how you can access a paper trading platform here on the CBOE website that you can try some of these strategies for yourself and get used to it. Because, as we all know, experience is the best teaching tool. So you can listen to me for a half an hour. And by the way, in case you're wondering, I am recording this. It will be available on FX Street for review and on my website as well. So so as we go along, you're going to have an opportunity to review it. But you have to apply this information yourself to really start getting used to it. So you're very welcome, Eddie. Across the top here, I've got there's a couple of tabs. I'm just going to point a couple of things out to you, so you might want to just make a note. Under the tab that says Trading Tools, there is a link here that says Virtual Trade Tool. And if you click on that, that's actually the paper trading software from Options Express. who I think is one of the top two options brokers, and in fact they're rated as one of the top two by everybody, options brokers in the country. And you can, no matter where you live, pretty much with very few exceptions, you can open an account with them. There's another one on here called Paper Money. That's from Thinkorswim, and they're one of the top two options brokers in the country, and no matter where you live, you can generally open an account with them as well to trade Forex options. But in the meantime, let's get into some of the detail here. Now, what I'm going to do is I'm going to bring up a chain sheet for the symbol XDE. So I just typed that on my screen. So if you want to make a note, that is the option symbol for the Euro US dollar options, XDE. And once I click on that, let me give you a couple of tips. Where I am, by the way, I'm on the quotes tab. So if I click on the quotes tab, then over here on the left, you'll notice that I'm on options chains. So that's where I'm located here on SIBO. And then XDE, and if I were looking this up, I'd want to put the symbol here and then click indices, because that's what XDE is. It's not the currency itself, it's an index of the spot price. And then, of course, I'd click Get Quote. Now, I've already done that, so we don't have to wait for the page to refresh. Underneath this, you'll see a little thumbnail chart of what's going on in on the intraday market on XDE. You'll also notice that the price is delayed. So one of the things that you'll deal with as a FX options trader is that right now FX options are traded during normal US market hours, which is, let's see, my time is 7:30 a.m. So Eastern time, that's 9:30 a.m. To 4 p.m. Eastern time. So 9:30 to 4 p.m. Eastern time in the US. And so the overnight market is, closed. However, it's if you're a day trader, that would matter. If you're just a regular trader, it's not that big of a deal. And there's a lot of things you can do if you're active in the overnight market and you've got an options position on and you want to take all the risk out of that options position. You can just put the contrary position on in the spot market, and you're basically selling your option until the market opens. Okay, so underneath this little thumbnail chart of the intraday action that's out there, we've got what's called a chain sheet. We have calls on the left-hand side, and we have puts on the right-hand side. And we're going to talk about calls first. Right down the middle, we have a column called strike price. And what the strike price is that this means that when you buy a call, here's essentially what you're doing. You're buying the right to buy this currency contract at the strike price. So what that means is that if the option or if the currency goes up, you still have the right to buy it at whatever price you set. So if we bought an option to be able to buy this currency pair at $1.42, just move the decimal point over to. So if we bought the right to buy this currency at $1.42 and then it goes up to $1.47, well, we just made 500 pips. So it's the same concept. What you're doing is you're just kind of freezing your price in time, and then as the option goes the direction you expected it to go, you make money. Or of course, if it goes against you, then you start losing the amount you had invested. Now, up here at the top, I have expiration, and I can select whatever expiration month I want. But the longer in time I go out, the more expensive it becomes. So one of the most common questions that I get is, well, okay, so I get what you're saying, but how far out in time should I go? And here's my rule of thumb. I would suggest that you start with this and then see what works for you. But I generally will go out to the current month. So I'm trying to go out about 30 days. And the options will expire on the third Friday of the month. So in fact, they expire, October's expires tomorrow. November's will then expire on the 16th of November, so the third Friday in November. So they have about 30 days between expirations, which means that normally we would be looking at, so right now if we were trying to make a decision, we would be looking at the November options. I'm not going to do that right now because the market is closed right now, it hasn't opened yet. the prices are all messed up. So it's going to be a little bit easier if we just look at the October options, and I'll adjust my prices to really explain what's going on. In the middle of our presentation today, the prices are going to go live again as the market opens. So at that point we'll be able to look at the November options. Okay, so second rule of thumb that I use to try to keep things simple, not only as a new trader, but as an experienced trader. One of the things that I use is a couple of rules of thumb. So number one, I'll go out to the next month, so about 30 days in advance in November, and I will use the at the money option. So, and most often I'm not going too far out from the at the money or the first one in the money or the first one out of the money, and I'll show you what that means. What that essentially means is that I'm going to whatever option strike price is closest to the current spot price. So let's imagine that the current spot price is still $1.42. So $1.42.10, that's where the market closed yesterday. Let's assume that we're doing this analysis at the close of market yesterday. And we're going to go down here, $1.42. That's the strike price that is closest to our current price. We're going to go over here to the left, and you'll notice there's two columns here. It has a 25 cents and then 30 cents in it. These are the bid and the ask. And since we're buying an option, we're going to be looking at the ask price. Now in this case, the way that options are priced is you basically take the bid and the ask price and you times it by 100. So in this case, we'd be paying $30. That's how much this option contract would be worth. And here's something that you might want to keep a note about. Option contracts are they have an underlying value, just like a spot contract does. So if you were trading one mini lot in the Forex, that basically equals $10,000 of underlying value, right? If you're trading one option contract, that also equals $10,000 of underlying value. So they're about the equivalent of a mini contract, which means that if you're trading a full lot in the Forex, well, you have to buy 10 option contracts, which in this case, so if these are 30 cents, so times 100, that's 30, so $30 a contract. If I want to buy 10 of them to equal one full lot, oh, that cost me 300 bucks. So pretty simple math. Now, so we're going to cheat a little bit because pricing is a little bit weird before the market opens. I'm going to give you, here's what the real at the money premium would be. Here's how much it would actually cost if we were going out to November. It's $90. So, and that price will vary depending on how far in or out of the money you are, and all these kinds of, there's a lot of variables. But when you're looking at this yourself, when the market is open, you're going to SIBO yourself. When you go down to check out the November calls, you'll see that they're priced at about 90 cents. Okay, let's so what we've just done is, let's say that we've executed that trade. We're going to go back to our charts and we're going to look and see how this compares to our other position that we've already got on. So we've got this, we're long the market, and so far we're up a couple of pips, and we've got a stop down here at the consolidation level about 90 pips away or so, which, as you can probably see now, I had kind of, oh, you know what, I forgot to turn my camera on, sorry. Okay, so now you should be looking at my charts. So I kind of set up this trade example so that we could contrast the long options position against this long Forex position with the option against it. Now in this case we're long, and let's assume that we were buying the at the money option, so we would be long at basically the same point. And we have and we paid $90 to do that. So we've got 90 pips at risk. So it's equivalent of $1 per pip, let's say. So our risk profile looks very similar in that if the market starts to fall, we can lose, and we'd lose all the way up to the same place that our stop loss is. So we'd lose 90 pips potentially. So we're in essentially the same position. Here is the big difference, and this is a significant one. If the market were to fall all the way down to $1.40, number one, we still own that option, and number two, we have not lost anything else than what we had originally invested, which was essentially the equivalent of our stop loss. So we just lost that option premium. If the market were to suddenly spin around and shoot right back up before the 16th of November, before this option expires, we would still own it, and this time we would be profitable. Now, the more likely scenario is that the market comes all the way down, hits this consolidation level again next week, and then bounces up again. Normally we would be stopped out, but with an option we would not be stopped out. We'd still be long that position. The leverage is very similar, so we would be making $1 per pip on our option position without having been stopped out, because the option basically acts as a stop and your long position at the same time without the big disadvantage. So that all sounds really good, because one of the things that I'll write about a lot of times to get people's attention about the beauty of options is I'll say, hey, you can trade options. You can basically be long the market without having to use a stop loss. I mean, how attractive does that sound? Well, there's no such thing as a free lunch in the Forex, well, except diversification. But besides that, there's no such thing as a free lunch in the Forex, and so you pay a price for every benefit that you get. Well, here's the big disadvantage. If we were just long up here at 42.90 and we have a stop down here at 42, well, it didn't cost us anything. We didn't actually spend any money to get into that position. If the market subsequently starts to rise, that's all gravy to us. That's all profits. It didn't cost us anything to get it. If the market drops, we immediately start accumulating losses, same as the option. But you have you don't have any fat in that trade, so to speak. So with an option, however, that premium that we paid, a lot of that is what's called time value, and that a lot of that $90 is value or money that we're going to that's going to melt away on us, even if the Forex starts to rise. So here's the big difference. I'm going to expand my chart here a little bit. So let's say that the market rises all the way up here to 45. All right, so we'll just assume that the market gets here in right before expiration on the 15th of November. On the 15th of November, if we were just long the Euro-US dollar, so we just bought the Forex pair instead of messing around with the options, we would be profitable to the tune of 210 pips? So that sounds pretty good. With the option, however, we would have that premium that we paid for the option would have melted away, and we will have lost a big percentage of it. So that $90 that we paid for the option in the first place, a chunk of it would have melted away, let's say about $70 in this case. And so we would still be up 210 pips minus the amount that we paid for the option. So it's this give and take. Now, in the example that I just gave, however, I've assumed that we were holding that option all the way through from today when we bought it, all the way through to expiration on the 16th of November, which you are not trapped in that time frame. If the market were to go up to our profit target, and let's say that we had reason to believe that $1.45 is where the market is going to go. So if we felt like that was our profit target and we hit that next Wednesday, we could sell that option and we would not have lost all of that premium. So we would have lost very little of it. And of the $90 that we paid, not only would we get our profit, the 210 pips or so, but we would get a big chunk of that $90 back as well, let's say 60 bucks worth. So what we did was we gave up a little bit of profit to eliminate the risk of being whipped out with this stop loss. So that's how these two contrast. Let's look at another example. I'm going to bring up, but we won't take as much time on this one. Hang on, somebody just asked the question. Let's see. Yeah, so actually, ABS is asking a really good question. He's saying, that if there was a major uptrend for that lasted a couple of months, and then we ended up correcting to the fib levels on the move. In fact, I don't know whether you're setting me up or not, but this is a great question. Let's talk about this. So he's saying if there was a major move, so let's use the euro US dollar as our example, and then the market pulls back to a fib level, which it did. So I just drew fibs from the top of the market to the bottom, and it pulled back to the 23.6% retracement level. So we've kind of got this interruption in the uptrend, and I hope I'm understanding your question right. And then we get a bullish candlestick pattern. So let's say we get a hammer appears down here at the bottom, which in this case didn't happen, but I get your point. But you get some kind of a bullish indication that the downtrend is over and we're at this fib level. Does it make sense to buy an option at this level? I think that it does for two reasons. Number one, although we're trading with the trend, we're buying this call, we do have this little retracement here, so we've got kind of this mini bearish trend. So it's a great way for us to, and what happens in consolidations when the market retraces? Well, we get a bunch of volatility, and it's a great time for the market to whip out a bunch of inexperienced traders. That's just what happens. So buying an option down here, if we were convinced that the market was going to pop up off of this 23.6% retracement level, and maybe there was a bullish candlestick pattern like the one you suggest here with a hammer, buying an option there, we don't care about volatility. That's okay because we can be whipped around and it's not going to whip us out. So great example. I do think that would be an ideal situation to use an option when you think you've got reason to be bullish, but you know that there's going to be volatility in the market, and that makes your stops vulnerable. Anytime you feel like your stops are vulnerable, great opportunity to use an option. Let's so shifting gears just a little bit. I'm looking at one of the other outrageous trends we've had in the market, and that's the dollar CAD over the last few months, and it's going down. How do we take advantage of this? Now again, we're not going to spend as much time on this one, but I think you'll get the point. So let's say I'm going to put a support level in here. Let's say that the market's been consolidating, which it has the last few days. So about a week now, we've been kind of stuck at about the 97.50 level. And or 97.20 or so, right in this range. And we think that the market is going to break out, but we want to take a position to the downside. Well, obviously we can short the dollar CAD, no problem, very easy to do. And we're going to do the same kind of analysis. Let's say the Canadian's not as volatile, so we're going to put a stop right here. Just right through that doji from a couple of days ago. It's where the market stopped 2 days in a row this week, right up here at about 98.17. So we've got we got about 100 pips or so worth of play. So we're down here at 97.20 is where we're short, and we got to stop at 98.11. So about 90 pips worth of play. And on a daily chart for a trader who's trading on the weekly to monthly time frame, this makes a lot of sense to put your positions in like this. This is not in fact, this is an analysis I'm sure is being repeated all over the world right now. Sorry, I just had to take a sip of water. So, but what's our alternative? Same thing, same idea. I'm going to go back to our chain sheet on SIBO, but this time, now we're dealing with the Canadian dollar, so I'm going to give you another option symbol, by the way. This is CDD, and you'll notice I've got indices selected. I'm going to get my quote. Let's wait for that to refresh. Now, by the way, while we're waiting for this, I get a lot of questions about. Oops, sorry, forgot to turn my camera back on. Okay, so now you should be looking at my webpage again, and I went in here and I clicked CDD, and then I selected indices, and then I hit get quote. Okay, so while I was talking and forgetting that my camera wasn't on, it brought up the Canadian dollar FX index. And now, of course, this is now this one's going to be very, very close to current prices because the dollar CAD isn't really moving anywhere right now. But we brought up the dollar CAD. Works exactly the same way, but this time we are interested in a put, a long put. So if you're making a little cheat sheet for yourself about the introduction to options, I would write down a long put is bearish. So if we're bearish on the Canadian dollar, or the dollar CAD, which we are, I would imagine all of us are, then we're going to be buying a put, and we just go down to our chain sheet. Calls on the left-hand side, we're going to ignore them. Puts on the right-hand side, our current spot price is 97.65. So you'll notice that all they do is the only difference here, the only thing you have to get used to is moving the decimal point over 2 places, and it just makes the pricing a lot easier. But just ignore it; it's no big deal. So 97.65. So that's where the spot price was when the market closed yesterday. We go to the at the money option, which in this case is right up here at the very top. We have a bid and an ask right now and the pricing is a little skiwampus. So when I was preparing this, I went back and checked my prices yesterday to make sure that I had prices available. So I'm going to kind of cheat a little bit by telling you what the actual prices really would be, even though we can't see them yet. The market's still not open. It's going to be open in another 45 minutes, and then we'll be able to see live prices. But you'll get the idea, because yesterday's prices were 55 to 65, so we had a 10-cent spread, or that's really the equivalent of 10 pips. So we have a 10 pip spread. I'm going to give you a little tip. When you're dealing with an exchange, unlike a dealer, a Forex dealer, you're dealing with multiple parties. So it's perfectly reasonable, and in fact everybody should put in limit orders that split the bid and the ask when they're more than 5 cents apart. So in this case, they're 10 cents apart. I split it right down the middle, and I would put a limit order in for 60 cents. Chances are extremely good that you're going to get filled at 60 cents. So it's something everybody does. Don't just pay the ask price. Clip it down the middle, you'll usually get it. And if you think the market's running away from you or whatever, don't get panicky. And in fact, panic may be a bad thing. So it might be a warning sign to you. So needless to say, the actual price for the at the money option in this case would be about $1. And if we go back to so I'm going to refresh my camera here. Remember to do it. The at the money price would be about $1, which means that I've basically paid $1, and I could lose $1 worth of value if the market just starts to scream to the upside. But that's the max. Well, $1 times 100 is $100. Well, that's the same thing as saying 100 pips. So it's the same thing as saying that I have a 100 pip stop loss. It's really not that different. The only difference is that if the market gets up here to 99 and then goes down in 2 weeks, you're still making money. Whereas if you hit your stop, you're out, and then you got to reevaluate and see if you want to get back into your trade. So the same benefit. In fact, I'm gonna pause my camera, and we're gonna go to our risk graph. I'm gonna bring up a clean one here, and here's what a put looks like. So in this case, it doesn't, if prices are rising, we don't make money. We make money if prices are falling. So it's very simple. We just, if this is our strike price, so let's say that's the current price in the market. Oh my gosh, I apologize. People are keep having to remind me to refresh my camera. Okay, so you should be looking at my little graph here. And what we're going to do is we're going to try to understand, well, okay, so how does the risk graph for a put work? If we have the prices down here for the dollar CAD, and right here in the middle, this is where our strike price is, loss and profit. Here's exactly how a put looks. It starts at a loss because we paid a certain amount, which in this case was $100 per contract, but then it has an unlimited profit potential that will appear as prices fall. So you'll notice as we go here to the left, as prices fall, unlimited profit potential. So the same idea as a call, but just in reverse. In fact, as long as we're looking at this, I'm going to give you a sneak peek on one of the strategies I'm going to show you here in a minute. What happens if you put the two risk graphs together? So if we put a call risk graph over here on the right hand side and a put risk graph over here on the left hand side, what that's telling us is that if you were to do both things, if you were to buy a call and a put at the same time, as long as the market goes far enough one direction or the other, so as long as it goes up or down far enough, you make money, which is a pretty good volatility play, and I'm going to show you that here in a minute. Okay, we're going to go back to my charts, and I am refreshing my camera right now. Okay, you should see my camera. Right now I'm back on the Canadian dollar. We're going to shift focus a little bit, because one of the questions that I'll get all the time is, you know, I write a blog, and which I really enjoy, and when I'm talking about the live market, I'll get lots of questions about what do I mean by placing a hedge, because in the Forex, hedge can mean a couple of things. So let's say, for example, I were short the dollar CAD and oil prices were beginning to come down, and so I was getting nervous that my dollar CAD was going to get volatile. And since I'm short, I'm nervous that the dollar CAD is going to rise in price, which would not be good for me. But, you know, ultimately, I've been in this position for, you know, let's say a very long time, and I've had, let's say several months, and we've been right for a long time, so I'm feeling pretty good. But I want to make sure that I'm not taking too much risk. There is a way that I can hedge using an option. It's really simple, and we're basically going to do the same thing that we've just been talking about, but I'm going to add it to my short position on the dollar CAD, and so it's more of a combination. And in this case, it's so this, and what I should say is, oftentimes, so when I say hedge like that, as in taking risk off the table, that's a little bit different than what a dealer will sometimes characterize the word hedge as. Oftentimes a dealer will say that the word hedge means that if you're short the dollar CAD, you can put a long position on the dollar CAD at the same time that won't wash out your short position on the dollar CAD. But when I see those kinds of positions on, I have a hard time understanding why somebody would do that, because it's the same thing as just getting out of the position, except, I mean, you're still in and out, you know, the spread. And I suppose on a very short-term basis, if you're trading volatility announcements and things like that, it's not a bad idea, but it would be tough for me to justify why I would want to do that. However, hedging with an option makes a heck of a lot of sense, because let's say that we're short the dollar CAD, and you know, we think it's going to go down, but in the meantime, we think that there's a possibility that over the next couple of weeks it might get pretty volatile and it could go up, but we don't want to put a stop loss in, and we don't want to exit our position. It's easy. All we have to do is buy a call, because if you're taking notes, you probably wrote down that buying a call is bullish. Well, if we're short the dollar CAD, that means that ultimately we're actually bearish on the dollar CAD. Well, if we want to add a hedge, that means we're going to be adding something that goes the opposite direction. So we're going to be putting a bullish position in against our bearish position. Well, if we buy a call down here at the money price, and then the market subsequently breaks out and turns out that you know, this was the absolute bottom of the dollar CAD for the next 2 years, and you know, the market begins to rise significantly, what we've done is that call is going to gain value as the market rises, offsetting our losses on our short position on the dollar CAD. So once again, we're short the dollar CAD, which is great, but we put in an option position, a call on top of it, that will wash out our losses if the market rises. And if the market continues to drop, no problem, because the losses on that call, which, you know, so subsequently the call is going to start to lose money, right? But the difference is that the call has a limited loss. It's an insurance policy. Pip Sniper just commented that it's an insurance policy. That's exactly what it is. And in fact, oftentimes that's the analogy that brokers will use to try to explain what is a protective option. So here's the rule to remember, and this will make it very easy. If you want to put a hedge on, so as you're paper trading this over the next month or two and trying to get used to this, and you want to put a hedge on against a long or a short position, just put the opposite option position on. So what that means is if we were short the dollar CAD, we would put a long call on, and if we are long the euro US dollar, the underlying spot position, and we want to put a hedge on, we would put a long put on. The put is going to gain value as the market falls, which is going to offset our losses on the euro US dollar. In fact, the hedge is so perfect, we know in advance what the maximum loss is going to be, and that is if we were to use an at the money option like I've suggested, you just capped your losses no matter what between now and expiration. You've just capped your losses at just whatever you paid for that option. And if you decide that tomorrow is the day that you want to get out of this trade, no problem. You sell your long position on the euro US dollar and you sell your put. So because the market is so liquid, you can get in and out just the same as you would otherwise. So if you decide that you don't want to wait till the maximum loss is there, the market has fundamentally changed. Turns out we were all wrong about the housing market in the US, and prices begin to rise again, so we think the dollar is going to increase in value. Well, that's a fundamental change. We can get out of our position, including the option position, very liquid, no problem. Okay, so let's go to. I have to tell you that probably my favorite strategy is one called. I'm trying to decide which pair I want to do this on. I think I'll do it on the pound dollar. So probably my favorite investing strategy out of all of them is a strategy that, and it's been applied by millions of traders, I'm sure, all over the world. Well, thousands anyway. And it's a covered option. And I think it's one of the best examples, because if you're taking some notes and you're drawing this risk graph with me, what you've probably noticed is that the protective put or call is essentially exactly the same trade as just buying a long put or a long call. And so although it has its place, I agree, they're very equal. And so you start to think, well, why mess around with two positions when I can just buy the long put or the long call instead of being long and short or long both positions at the same time? Well, so the next combo position that I'm going to show you that involves both a spot position. So we're going to be long the pound dollar, and we're also going to put an options position against it. And now this one is one where the option and the underlying really have a very synergistic relationship. But I have to give you a couple of other tips. So this is a covered option, all right? And so if you're making a little note on each one of these strategies, this one's a covered option. You can play it on both sides of the market, bearish or bullish, depending on what you are on a particular pair. It is designed to be longer term, so which means that you're essentially you're trying to leverage long-term opportunities. You're not getting in and out of this trade all the time. In fact, you're making an adjustment to your trade about once a month. Which, in my opinion, is something that's very attractive about this opportunity, because I don't have to manage it constantly. I always call it tickeritis. When you can't leave your charts alone. And there's actually, by the way, some of you may have experienced this. There's actually a psychological disorder that even normal people can get, where you become obsessed with your charts and you can't leave them alone. It makes you make irrational decisions. So if you have ever felt like you need to have a strategy that can help you break that habit, this is one that I really love. All right, now I'm gonna, enough of the pitch. I'm gonna tell you exactly how this works. Let's say that our overall outlook on the pound dollar is bullish, which I think is reasonable. And I usually try to play this on pairs that are really have a nice, really strong trends. But you don't always know when the trend is starting and when the trend is ending, so I think this is going to be very realistic. And let's imagine that we're opening this position today. Okay, so we're going to be opening this position today. And however, what we do today is basically what we would be doing every month as we manage this position. And here's the way that a covered option essentially works, is that we take a position in our Forex pair, which in this case, because we're bullish on the pound dollar, we're going to buy. I just can't resist to draw these this little consolidation here. I mean, how classic is that we just broke out of this awesome pennant? It's like out of a technical analysis encyclopedia. Anyway, so we become very bullish on the pound dollar here, but at the same time, so we automatically go long, and we're going to go long at a price of, right now it's 2.0494. So 494 is our entry price, but we would like to take a little risk off the table. We're not too, because we're long-term traders, we're not using excess leverage, so we're not too worried about placing a stop. And in this case, I'm going to say, don't place a stop, because we got very, very low leverage in this case, because it's a more long-term strategy. So we have no stop on here, and we're thinking, well, if I'm going to operate without a stop, I want to have some kind of ability to control my risk. And which a covered option comes into play right there, because it has two benefits. Number one, it pulls a little risk off the table, but number two is it pays a little income. So every month, even though I'm hanging on to this position, let's say I'm in and out of this pair for a number of years, every month I'm getting this little payment on this option trade. Because what we're going to do is we're going to sell. So if we're bullish and we want to pull a little risk off the table, that essentially means that we're adding a hedge. Well, if we're adding a hedge, that means we need to put a little something bearish in here. Well, if we put a little something bearish in here, that means that we're going to be selling a call. Buying a call was bullish, selling a call is bearish. So if we're bullish on the pound dollar and we want to write a covered option, we're going to sell the call on the pound dollar. I'm going to go back to my web browser, and we're back at SIBO again, and I'm going to bring up the options for the pound dollar. In fact, actually, you know what I'm going to do? I'm going to show you a couple of things. I'm going to go into BPX. Now, you may or may not want to write that down, but and I'll show you why here in just a second. So BPX is going to come up. Now wait a minute, what's wrong with this price? I'm curious as to whether anybody can immediately tell what is wrong with this spot price. Now, besides the fact that the decimal point is over too far. So move it over 2 decimal points, 0.48. What's wrong with that? It's the other way around. That's exactly right, Sam. So one of the things that you have to look out for when you're trading Forex options is that there are two kinds, and when you're the way that I prefer to do it is to buy the option that is priced the same way that the spot Forex is priced. So if the spot Forex is pound dollar, then I want a option contract that is priced pound dollar, not as this one is dollar pound. Okay, so I just wanted to make sure that you saw that, because that confuses the heck out of people when they see that the first time. And I'll give you the real symbol for the one that I want is XDB. I'm going to select indices and click get quote. So good job, Sam. You'd be amazed at how many really experienced traders I talk to who look at that and they say, I cannot figure out how that's priced. Okay. So here are our pound dollar options, and we're going to go down to, and again, let's imagine that we were doing this analysis yesterday at the close of market, so the market still hasn't opened yet. We still don't have live prices yet, but we're getting closer. And the spot price was actually 2.0409 instead of 494. We would go down here to 204. That's our at the money price. That means it's the strike price that is closest to the current spot price. And in this case, we're selling a call, which means that we would be selling at the bid. Now, I'm going to cheat a little bit. The prices here are a little scawampus. They go crazy overnight. It's just the way that it is. So if you want to see live prices on SIBO, you have to wait until the market is open, which again is at 9:30 Eastern time in the U.S. But in this case, so we're over here on the call side, on the left-hand side, but this time we're going to be selling this option, which means that we're going to be selling at the bid, or since we're 10-cent spread here, we're going to split it down the middle, which is 40 cents times that by 100 is 40 bucks. 40 bucks a contract, and we're going to be paid that. So what we did, what your options broker will call that is that you're writing an option. You're the person who's basically creating that option opportunity. And in reality, instead of 40 cents, by the way, for a full month on the pound, it's really good. The premium is quite juicy on the pound. Of course, there's a lot of risk on the pound, but the premium would be more in line with about $125 for 30 days. So 125 pips. So here's how that translates into protection against our position. So I'm going to refresh my camera. I'm going to go back to my charts. Okay, so we're back here in our charts. We know that we've just sold an at-the-money option, an at-the-money call on the pound, and we were paid $125 for that. Well, what that means is that if we were bullish here, so we got into our position right about there, and we're long, we have 125 pips worth of downside protection. So if we got long at 494, then we're 394, 374, 369 or so. So we actually have all the way down here 369. Okay, I'm real close. All right, I have all the way down to there. If the market began to drop, I have that much protection built in. And I have a little bit of distance up here to the upside because if the market starts to rise, I have a little profitability. So this sounds a little weird because you immediately look at this opportunity and you're thinking, well, I get the fact that you've got some downside protection because you sold a put, which gave you some money right up front. I mean, you sold a call, which gave you some money right up front, 125 pips worth basically. So as the market falls, I have kind of this built-in profit margin that was paid to me that I don't have to pay back. And then as the market goes down below this level and continues to drop, then I start accumulating some losses. But you really capped your upside because here's what happened. If the market were to continue to rise, that call is going to become much more valuable. And that means that whoever bought that call, we're the seller, and so selling that call was bearish. We begin to accumulate losses that offset our gains on the pound dollar spot contract. So we've capped, and so up above this level, so we had a little bit of margin. About I think in that particular option contract we had about 40 pips worth or so. That's too high, but so we had a little bit of margin for some upside. But if the market really starts to go, our gains are washed out. We've kind of capped our gains. So what's the advantage? Well, here's the big difference. The big difference is that we've limited our downside. So what we've done is we've basically changed our focus from concentrating on profit targets and how far is the market going to go to how much risk can we pull off the table right now. So we're almost looking at our trade from the perspective of an exit first rather than an entry first. Here's how this actually plays out. And if you would like to do a little bit more research on this, you might want to make a couple of notes. You can index and test this strategy, which I actually have, by the way. If you're interested in seeing more about it, I've got a couple of reports on my website you can go check out if you would like. But it's also been indexed by the SIBO themselves. And what they did is they said, well, if writing covered options is such a great strategy, how does it actually perform over time compared to just being long or short a particular position? And what you'll find is that it does two things. Number one, it improves your returns a little bit. So it may boost your returns by 10%. So if normally you're making 15% a year, now you're making 16.5% a year. So it boosts your returns by a little bit if you were using the same kind of strategy, but you're selling an option against it. But the big benefit is that it takes tons of volatility out of your account. So those big drawdowns are no longer so big because you keep cutting the knees off by selling that option because you're collecting that premium every month. So in this case, and the whole idea is that we love to think about and I hear this all the time. Oh, the Forex trends like crazy. Well, yeah, that's true, but on a month-to-month basis, it will channel a lot. So I mean, we've gone. It doesn't even look like it, but we really haven't moved all that far, even in the last month. So by selling that put or selling that call against this position, what we're really doing is we're saying, look, I think the market's going to move. In fact, I think it's going to move, enough that it's worth it to be long. But I'm going to sell this call and cap my gains because I know it's not going to move that much. Just on average, it just doesn't move all that far. So I'm managing my risk very effectively without having to really cap my gains in reality. Sure, I'll miss some of the runaway markets, but over time, it evens out because I'm going to have a lot more of this over time than I'm going to have of these kinds of big moves. That's the way that it works out if you test the strategy. And depending on what you test it on, so if you're taking a note here, you might be interested in reading the study on the SIBO. If you go into the SIBO and if you will search for, so go to the SIBO website and search for BXM. So I'm going to write that down for you. That's a great. I think it's one of the most thorough studies that's ever been done on this particular concept, and they prove how it helps the volatility in your account without really hampering your returns over the long term. So it's kind of a no drawback situation. Let's change gears here just a little bit. Let's say that although I keep hesitating to go to the yen, and I have to confess it's a bit of a personal thing with me. The yen just seems so risky right now. It freaks me out. Everybody who reads my blog, they're like sick of me saying there's risk in the yen, there's risk, but hey, I'm right, aren't I? There is a lot of volatility in the yen, and therefore, if you're determined to be a yen trader, writing covered options is a great way to pull some of that risk off the table. Except this time we would do just the opposite. So let's say, for example, that we are bearish on the dollar yen, and we're getting in. So I'm going to put a line here right through our entry price. So we're going to get short at 115.54. And now we could put a stop here, so we could put a stop up above the market. Let's say give it 100 pips or something like that to play, or we could. There we go. There's about 100 pips. Or we could leave it uncovered and put a hedge on in the form of a covered option. So in this case, because we are bearish, we want to put a bullish hedge against it, which we talked about when we were buying insurance, if you will, with the protective options. That means that we would have been buying a call. But just the opposite of that, if we are wanting to put a little bit of a bullish hedge in here, and against this, so we're short the market, we want to put a little bit of a bullish hedge in there. Well, we just we put a short put. So it's interesting. If you sell a put, that's actually bullish. And people who are kind of superficially familiar with options or have been trading them a little bit, kind of dabbling in them, it's really hard for them to get used to the fact that the word put does not equal bearish. Selling a put is bullish, and buying a put is bearish. So those are what really equal bullish and bearish. And in this case, all we would do is sell a put. Since we're kind of sticking with this same idea, we would sell a put at the money, or maybe even one move out of the money. And let me show you what I mean by that. I'm going to turn my camera off. I'm going to go back to SIBO. Okay, now in this case, we're going to pull up YUK, and I'm going to indices. I'm going to get my quote. So if you're writing these things down, by the way, these symbols, I'm going to show you two places that you can go here in just a minute before we go back to our charts, where you can find a lot of information, a lot of great information about the Forex options that are available right now, because we've kind of been flipping back and forth between those that are being offered. So YUK, this is the yen, and so yesterday's spot price at the close of the market was 115.46. In this case, we don't have to do anything with the decimal point. So 115.46. If we go down to our at the money strike price, so in this case we're going down to our 115.40 or 115.50, and we're selling a put. Now the bid and ask here, because we're pre-market, in fact we're 15 minutes before the market opens, so it gets really crazy. So you can see the bid and the ask gets extremely wide at 5 cents and 4.80. So just ignore that. Here's what it basically works out to be. The 1550 puts, if we were doing this at the close of market yesterday, would have been worth about $115. So at $115, it's basically 115 pips. So we're going to go back and we're going to graph that on our chart and see how does that really play out on the dollar yen. And I think it's a really stark example of where what kind of market really does well when you're applying this kind of a hedge against it, and how it works out so well over time. And then I'll show you a couple of tricks that I use to determine the trend, so I know, do I want to be short the yen or do I want to be long the yen and selling a call? Or do I want to be short the yen and selling a put? Which one do I want to be? I have a couple of tips that I like to use, and then I'll show you what you can use yourself. But before we leave the browser here, I wanted to show you two things. Number one, up here at the top, I have the ICE, www.ise.com. This is the second largest options exchange in the US, and there are the Forex options that are listed here includes the YUK that we were just looking at. Now, just because they're listed here, you can trade them on any exchange. It doesn't matter to you, other than you can get a lot of cool information. If you go to their page, FX options, they have all kinds of little tutorials and stuff like that. It's really a nice site, a lot of great information. The other site that I wanted to refer you to is www.phlx. This is the Philadelphia Stock Exchange, so phlx.com. And this is where the other Forex options are listed. Again, available through your options broker. It doesn't make any difference. But when we were looking at the XDE and the XDB, that's where these are listed. So why does that matter to you? Why would you want to know? Well, besides the little information and things like that are helpful on those sites, the other thing is when you're talking to your broker, because Forex options are new, and I know this will probably shock most of you, but retail brokers are not always the most experienced brokers in the industry. Excuse me, I took a little sip of my drink. So now that you've recovered from that shock, it will probably not surprise you to call your options broker and say, hey, I'm interested in trading FX options, and for them to say, I have no idea what you're talking about. So you can refer them to those two sites and they can get all the information they need to be able to help you. So question that was just asked from CVJ. John, do you have a preference with the ICE or the Philly, since the exchanges are offering different products due to the infancy? Yes, I do, and here's the easy explanation. Depending on, so they each offer options on basically the major pairs: the euro, the pound, the franc, the Aussie, the yen. I know I'm forgetting something, but I can't. The Canadian. They basically offer options on both of those. Okay, on all of those. So the offerings are essentially equivalent. The products themselves are not necessarily inferior or superior. So they're equivalent. I think they're very fairly priced. They look good. I like them. But you're asking, well, which one do you prefer? I always go with whatever contract is priced normally. So for example, those that are listed on the ICE, their pound and euro contract is reversed, which is weird, and I don't like that. So I like to, so I'll trade the euro contract, the XDE that's listed on the Philadelphia exchange. But in reality, it doesn't even matter where they're listed to you guys. It doesn't matter at all. It doesn't matter to me either. What matters is, do I know all the symbols that I need to make sure that if I want to trade the pound, do I know what symbol that is? Well, it's XDB, because I wouldn't want to trade the other one anyway, which is BPX. Do I know what the euro contract is? Well, that's XDE. What about the dollar CAD and the dollar yen? Well, that's CDD and YUK. So those same symbols that we've been going over today. I just prefer those options that are priced the same way that the underlying currency pair is priced in the foreign exchange. So I hope that answered your question. Okay, let's go back to our charts. Okay, turn my camera back on, and we're short the dollar yen, and we're going to be putting a bullish hedge on this, so that covered option, which in this case is a short put, so we're selling a put, and we got paid for that put $115 or so, or the equivalent of about 115 pips. And remember, it's just in multiples of basically each one of these contracts is worth about the same as a mini contract. So depending on how many contracts you are short, that's how many option positions you're going to put on. So if we want to graph how far our hedge actually goes, so 115.55, we want to go, so 116.55, so a little bit right about there. So this area between here and here is hedged. So the CVJ, yeah, so your comment, it makes sense the store is irrelevant. That's exactly right. It's the brand. I couldn't have said it better. It's the brand of product that you want to buy. Yep, perfect. Okay, so between our entry price and this 115 pips that we go up, that's free and clear. If the market shimmies around in there between now and expiration in November, we're okay, because we're not going to be accumulating losses, because that premium that we were paid when we sold that option, when we created that liability, has offset those losses. To the downside, if we still have a little bit of profit opportunity, which was basically the difference between our entry price and the actual strike price on the option. So we still have a little bit of profit opportunity. Well, if you look at this and you think, okay, well, how does this actually work out in real life? Well, if we zoom out, you'll notice that the market will channel within a range a lot. And on the net, what you've really done is you've helped to kind of clip the real highs and lows out of your account. So you've reduced this volatility, and that reduction in volatility has done a couple of things. Number one, because you're collecting a premium every month, you're still making money. So you're improving your profitability, because as you smooth your equity curve, it makes your money management more efficient, because you don't have these big drawdowns, or at least I should say your drawdowns are not as big. Your position sizing every month isn't dramatically different. It's very smooth and very efficient. That efficiency translates into extra profitability in the Forex. Knowing how to trade is only half of it. Knowing how to manage your money is the other half, because it makes a significant difference and accounts for a lot of the performance improvement that you get when you're writing covered options. Okay, so let's look at this on a risk graph, because there is something that I want to make sure that you understand about how a covered option works, because there is still some risk. Here's basically the way that it works. Now this time, because you're selling the option, we're starting with our risk graph. So if we say that, the current price is right here. So here's the current price on the dollar yen, and we're writing this this covered put. This time we're starting from a position of profitability. And if the market rises significantly, oh my gosh, thank you, Sam. I keep embarrassing myself by not turning my camera on. Okay, so let me back up just a little bit. So we're on our risk graph here, but this time, because we're the option seller, we're going to be starting in from a position of profitability, which is great. Let me preface this just a little bit. I read a really fascinating study a few years ago where the Chicago Mercantile Exchange watched option sellers versus option buyers, And even in an uptrend, the option sellers who were selling calls, which is bearish, uh, were doing better than option buyers. So selling options is a really great way to go. So we're starting from a position of profitability, but as the market rises, we do start to accumulate losses if the market rises too far. So you still have this risk, but the difference is, so let's contrast this with a spot position. How would a spot position look on this graph? Well, it would start right here and go down. So that's basically what you've done, is you've created this little margin in here. You've created some fat in this trade that you didn't have before. And the trade-off is, of course, that if you're just short the yen, you also have unlimited upside potential. But we know that the market is volatile. It is crazy. If we want to use any kind of risk control on our against our positions, we're probably going to get whipped out once in a while. And so you'll find that if you test these strategies, you'll find that the studies are right, and you can actually outperform a similar strategy without the covered option versus with. Let's go back to the let's go back to our charts. Turning my camera on. All right. There are a couple of ways that let me give you one tip that I use. This is a strategy that I really like as far as trading this particular strategy, which because the question when you're trading this is, all right, well, I get it. So if I'm short, I'm going to be selling a put against it to take some risk off the table and to smooth my returns. If I'm long, I'm going to be selling a call to do the same thing. But how do I determine whether I should be long or short? Because these are positions that I'm going to be in for a while. So I'm going to be in for a few months. You know, how should I determine, you know, what I'm actually trading? Well, it's really nothing more than a trend analysis, and there's a number of ways that you can do this. I think probably the two best ways would be either applying a moving average, so using a moving average crossover. And I know everybody hears, you know, all the technicians out there hear moving average crossover, and you're thinking, oh my gosh, but no, when you're selling an option against it, you remove a lot of the inefficiencies of a moving average crossover. So using something that's nice and wide, so let's say a 200-day moving average and a 50 moving average. If the 50 is underneath the 200, you're short. If it's above, you're long. And that's how you're adjusting those positions. Alternatively, here's what I do. I'm a big fan of the Commitment of Traders report. So I'll watch the Commitment of Traders report with the Forex futures, and I'll just watch what is the big money doing. Is the big money long or short? And they don't change their position very often, and it tends to be very much in line with the trend overall. So if I just kind of flip back and forth with the institutional traders, it works out pretty well, because I'm, again, same thing with the moving average crossover. I'm removing a lot of that volatility, or a lot of the inefficiency that appears by selling that option. Okay, so we got. I'm going to do one more strategy here. Let me just take a drink of water. You'd be surprised how dry you get talking for an hour and a half. Okay, I'm going to. I want to pick a good pair. You know what? I'm actually going to do this example here on the pound, because I think it's got to be the best one for. And I even wrote a blog post about this yesterday. The pound dollar. Hasn't it been interesting? It's got this really tight range. In fact, yesterday I was writing this blog post saying it's got to break out. I mean, we're running out of time here. And but the question really is, well, the economy in the UK is very sensitive to what's going on in the US. Overall, it's not like it's not like their growth is out of control or anything. So it's very hard from a fundamental perspective for me to say, well, which one's really likely to strengthen versus the other, the pound or the dollar, because I see them as pretty evenly matched. So how do I deal with this? What would I do if I'm uncertain about the trend? And even this breakout that's occurring right now, how far is that really going to go? We've come right to resistance. Outside of this little breakout here, it's held 1, 2, 3, and now 4 times so far. So what's going to happen? Well, I know a couple of things. Number one, I know what I don't know. I don't know on the pound dollar, and I can say personally I am not trading the pound dollar right now because I have no idea what direction it should be going. It just seems very evenly matched. But what I do know is that the market does not deal very well with this. Anytime the market does this, these really tight ranges, I start to get pretty excited because there's an opportunity here, especially when you get this little consolidation pattern. And especially if you're looking at a pair that you're thinking, well, I don't know that I feel confident enough to take a traditional, to take a long position on a breakout to the upside, or even a short position on a breakout to the downside. But what I do think is that this volatility, this really tight range, cannot last forever. So what can I do to take advantage of that? And this is, as far as you speculators out there, and I would include myself into this, is one of my favorite strategies. We are going to do a long straddle. There's a version of this called a long strangle, which we probably won't cover today, but a long straddle, and here's exactly how it would work. And then we're going to look at it on the risk graph so we can really see, all right, how does this really work? And do I think there's a reasonable probability for me to be able to make money? And where do I hit a maximum loss point? And how likely is that? So if the market is right now, we're at 22.479. So we've actually come down about 15 pips this morning already. That's interesting, just while we've been talking. Okay, so we're at 479 or so, and we think that the market is going to go one direction or the other. We just don't have any idea which direction it's going to go. Well, one of the things that we could do is we could simultaneously enter a short and a long position in the Forex, but the only problem with that is that they're going to perfectly offset each other indefinitely. Because the longer the market goes, if the market goes to the downside, well, our long position is going to lose money as quickly as our short position makes money. And the same thing to the upside. So that's a difficult dilemma that a lot of people are faced with. In particular, that's particularly problematic when you're faced with, let's say, the week of a big announcement. So you're getting ready for, labor or a monetary policy announcement or whatever it is, and you want to take advantage of a move in the market. Well, if you try to take a position on both sides, then at some point you got to decide to get out of one of your positions, and by the time you gotten out of that position, you're starting basically from scratch. You might as well have just waited and then gotten in the long position at your convenience. There is an alternative. So what you can do, if we are both bullish and bearish, so we're more neutral than anything else, all we know is that volatility is going to appear. We can straddle the market by buying a call and a put. And here's what that looks like. So I'm going to stop my camera. We're going to go to our graph. I'm going to start my camera again. Let's bring up a fresh one. Here's exactly what that looks like. So let's say that the market right now, that we're right here on our little price chart. So prices going here. So this right here, this is 2.0479. So this is our entry. And we're going to buy a call and a put with exactly the same strike price, and again, staying at the money. What that means is we're going to be right here. We're going to be starting from a loss because we are buying that call and that put. But if the market goes up a lot, we're going to make money like that. And if the market goes down a lot, we're going to make money like that. So how do I determine how far the market has to move? It's really easy. Now we're going to have to make a couple of assumptions because because the issue is that this whole area right underneath here, all of that's a problem because that whole area is potential losses. So between our price, how far does the market have to go up before we start making money, or how far does the market have to go down to start making money? Well, that's a fair question. If we go back to oops, I'm going to stop my camera and start it again. And I'm back on my web browser. I'm going to go to XDB, indices, get my quote. These are free, by the way. I don't know that I mentioned that, but they're available to anybody. And all I have to do, so if we imagine that we were doing this at the close of the market yesterday, the spot price was 2.0409. So 20409, that gives me an at the money price right here, 204.90. If we were to, so we're going to be buying a put and a call at the same time. Now these prices are a little squampus because the market just barely opened 2 minutes ago, and these prices are delayed by 15 minutes. So when you're looking at exchange listed prices for free, if you're not working with your broker yet, prices are all delayed by 15 minutes. Not a big deal, but since we're doing this right at the market open, it's affecting us. So I'm going to cheat a little bit, and I'm going to give you the prices. Now here's the thing. We know that if we're going about 30 days in advance, that those options are going to be reasonably expensive. In fact, they're going to cost us about. I'll answer a question about the about which brokers do you use here in just 1 second. Okay, is that okay to put that off? That question off, Rumi? I'm going to turn my camera back on. We're back on our charts. So here's the thing. If we want to buy a call and buy a put at the same time for this little strangle, and we want 30 days in advance, it's going to be pretty expensive. So in fact, it's going to cost us about $120 per side. So that's about $240. Well, let's look at that. That means that's basically what we have at risk. But this is a two-sided coin. It's a very expensive trade, but it has a whole bunch of benefits, and let me explain what those are. So if we're in the position right here and we buy a put and we buy a call, both right at this strike price, and we wanted to be able to lost my train of thought there. Sorry guys. And we want to be able to see, well, okay, how far does the market actually have to go before we start making profits? Well, if the total cost was $240, then that means we need to put a line up here. So 479, so we're it's right about there, and right about there. So we got to be either above here or below there on November 16th in order to be making profits. Now, people look at that and they say, oh my gosh, that is a wide spread. I mean, anything in between here is a loss. Well, that's true if you make a couple of assumptions, because I said there's some trade-offs here. So number one is that if you're convinced that volatility is going to occur, then that much of a move in 30 days is not unreasonable. And if it makes that move in a day or two or in a week or two, you can get out of the position at any time that you wish. In the meantime, the only place that your maximum loss, that $240, actually materializes is if the market didn't go anywhere but stayed exactly at this price. So whenever you sold those positions, if the price of the index was at exactly this price, that's where you experience that maximum loss. If the loss actually declines the higher you go and the lower you go. If we go back to our risk graph, so I'm going to turn my camera back on, you'll notice my maximum loss is right there at that price. It shrinks and shrinks and shrinks and shrinks. So the probability of experiencing your maximum loss is extremely low. Chances are you're probably, if you're going to be in a losing position, you're going to be in one of these two tails here. And that risk is being offset with the fact that because you're long both of those positions, you still have unlimited gains. So if the market did move, let's say 500 pips or whatever it is, you've made significant gains without having to use stops and without having to accurately predict which direction the market is going. That's a long strangle. Or long straddle. It's a great way to kind of combine everything that we've learned about long option trading into a single strategy that works really well in a neutral market or a market in which you're very uncertain. I have reached the end of my presentation, and this was Introduction to Forex Options. I really enjoy talking about this. It's the strategies are, as you get in and get a little practice, you'll realize they're actually quite simple. the simple ones work best. It's always best to go with what's easy and simple. So I'm going to answer Rumi's question, and then if anybody else has any questions, I'll run us right up to our time limit here. If you have any other questions, I'll cut off at 1/4 to the hour. So Rumi, you asked which brokers do you use to trade the Forex? Let me answer that by giving you a tip rather than a recommendation, if that's okay. There are any options broker can give you access to, and so what I assume you're asking me is which broker do I use to trade Forex options? Any options broker in the U.S. can give you access to those, and in most cases, options brokers outside the U.S. can give you access to those in your account. It's simple. Here's what I would recommend. Rather than recommending a broker to you, here's what I would recommend that you do. Go to the CBOE, because they're an exchange, so they're not a broker. So the exchange, under trading tools, they have 2 paper trading tools. One's called Virtual Trade, and the other one's called Paper Money. And if you just click on trading tools, you'll see it there right in here, and you can set up a free account and you can paper trade them. Paper trade those 2 platforms and decide which one you like best, because the 2 companies that own those they're exactly like their live trading platforms, and they're the best 2 option brokers in the U.S. rated by Barron's and all this kind of stuff. So they're always rated number 1 and number 2. They kind of trade back and forth, and I think they're fantastic. Service is awesome. Prices are great. Liquidity is awesome. I mean, it's just so rather than recommend a specific one to you, do your own investigation and decide which one you like best. And surf around on CBOE, and you'll see other option brokers advertising. I'm just going past one right here. They're not too bad, and try them out. Most of them will let you try a paper trading account and see what you like. So do I trade other options besides the Forex? Yes, I do. I trade a lot of stock options, a lot of index options. So yeah, I think it's personally, I'm a big believer in diversification, and I think diversification is helpful not only within a market, so within the Forex, but across markets. If you have a portfolio where you're invested in equity indexes as well as Forex currency pairs, you're really in the catbird seat as far as diversification goes. So yes, I do actively trade, or I should say I do actively invest in other options besides the Forex, and specifically, and I would say mostly, equity options. So great question. Any other questions? Here's one thing I can tell you, by the way, a little bit more information on the question you didn't ask, Boyke, is options, once you kind of get sucked into that market, you'll never want to leave. It's so interesting, and there are so many fascinating things. I don't know if anybody out there follows home builders, but right now you can buy options from CBOE that are listed on the CBOE that all you have to do is buy a binary option that will pay you a premium if a credit event, quote unquote, if a credit event, so that would be like a bankruptcy, occurs in the home building industry before 2008 or 2012 is when they're listed. So that's just like one example of like how options they're all over the place, tons of opportunity, whatever you want. So what about leverage? Leverage is very similar. When you actually boil it down to your real leverage, it's a little bit less in the options market than what you're getting in the Forex. So, for example, in the Forex, you could basically say, well, if you exclude the outliers of 400 to 1 or whatever, I'd say the most common leverage level in the Forex is 100 to 1. But in reality, what's the amount of leverage you're actually using in your account? Maybe if you're super aggressive, maybe you're 20 to 1, maybe you're 10 to 1. When you're looking at your total account balance as a margin. So it's very similar in the options market. It's very, very similar, unless you're short, and then it's not as good. You basically have to post 20% of the option contract value. So it would be like trading with maybe 10 to 1 leverage. That's a good way to look at it. It does work the same way for other markets, yes. Have I automated this like an EA? I think I understand your question. No, I have not. There are software programs that will do that. I don't have any experience with them. I'm really a hands-on guy, But yes, there are software programs that can do that for you, and you might want to check them out. Well, thanks everybody. I'm out of time. I love doing these presentations. I'm so thankful that I was able to get in front of all of you, and great questions. I hope this was helpful for you. If you have questions for me that you would like some follow-up on, so something I wasn't clear about, or just want a little additional detail, please don't hesitate to send me an email. That's my email address, john@pfxglobal.com. I have been recording us, which fortunately is not admissible in court, so you can all breathe easy. But I've been recording it. I'm going to be delivering that recording to FX Street, and they'll be hosting it on their site for review if you need to go through it again. So thanks, everybody. Appreciate it. Have a great day trading.